All right, let's talk about the single most important idea in all of finance. Seriously, it's the one rule that basically runs the show for every single investment you'll ever make. It's called the risk-return trade-off. And honestly, getting a handle on this is your first real step toward making smarter money moves.
You know, at its core, investing boils down to one simple question for all of us. Do you want your money to grow like crazy? Or do you want to know for sure that it's going to be safe? It sounds easy, right? But the answer, well, that's where things get tricky.
Because here's the thing, you can't have it all. You just can't have maximum pedal-to-the-metal growth and Fort Knox level safety at the same time. You have to choose. And understanding how to make that choice, that trade-off, is really the secret to a successful financial journey. So in this explainer, we're going to break down exactly how this whole thing works.
So here's our game plan. We'll start by making sure we're on the same page with what risk and return even mean. Then we'll dig into the trade-off itself and see where different investments fit into the picture. We're even going to uncover a sneaky risk that comes with being too safe. After that, we'll talk about how this applies to you personally and wrap up with a couple of pro-level tools to help you navigate your journey.
Okay, first things first, before we head out on any journey, we need a compass, right? And in the world of investing, that compass has two main points, risk and return.
Let's start with the fun one, return. Just think of this as the scoreboard for your money. It's the bottom line. How much did your investment actually grow or shrink? It's the profit you hopefully walk away with. Simple as that.
And then there's risk. Risk is all the uncertainty that's wrapped around that return. It's all the what-ifs. It's the chance that things don't go according to plan. And yeah, it's the possibility that you could actually lose some or even all of your money.
Now, here's where it gets really interesting. These two things, risk and return, they aren't separate. Nope, they are completely, totally tied at the hip. You can't talk about one without the other.
So this is the big takeaway right here. If you want a shot at getting higher returns, you simply must be willing to accept more risk. It's a trade. You're giving up some certainty in exchange for the possibility of a bigger reward. And you can see this play out perfectly right here. As you climb up that ladder of risk, the potential for reward goes up with it. Which, makes sense. If you're going to stick your neck out and take a bigger gamble, you expect to be compensated with a shot at a bigger prize.
But, and I really have to hammer this home, that word potential is doing a lot of heavy lifting. Taking on more risk does not, I repeat, does not guarantee a higher return. It just opens the door to that possibility. It also, and this is the important part, opens the door to bigger potential losses if things go south.
Okay, so let's bring this all down to earth. What does this look like with actual investments? The things you can put your money into. Where do they all fit on this spectrum?
Down at the very bottom of the risk ladder, you've got things like cash and high-yield savings accounts. These are the sleep well at night assets. Your money is about as safe as it gets. But the trade-off? Well, your potential for growth is tiny. The goal here isn't to get rich. It's just to keep what you have.
All right, let's take one step up the ladder. Here we find bonds. The simplest way to think about a bond is that you're lending your money to a government or a big company. They're generally a lot safer than stocks, but they offer a better return than just sitting on cash. They're that solid middle ground.
And then we get to the top of the ladder, stocks, or what folks in finance call equities. When you buy a stock, you're literally buying a tiny slice of a company. Stocks give you the greatest potential for long-term growth, but they also come with the most day-to-day bumps and bruises, the highest volatility. This chart kind of pulls it all together in one place, but I want you to look really closely at that top row. See that? Even cash, the quote-unquote safest asset, has a primary risk listed right there, inflation risk. And that, my friends, leads us to a fascinating and really crucial plot twist in our story.
So far, you'd think, okay, if I'm a cautious person, I just stick to the safe stuff, right? But there's this invisible danger, this silent thief that lurks in the safest of places and eats away at your wealth without you even noticing.
This is what a lot of us think, right? Hey, if I don't want to lose a single dollar, I should just stick it all in a savings account and call it a day. Well, not so fast.
Just look at this number for a second. $109,000. Let that sink in. Assuming a pretty normal 3% inflation rate, that's how much money you'll need in 30 years just to buy the same stuff that 45 grand buys you today. If your safe investment isn't growing faster than that, then you are quietly but surely getting poorer every single year.
So you see, we have to think about two totally different kinds of risk. There's volatility risk. That's the scary up and down roller coaster of the market that we see on the news. But then there's inflation risk, which is the silent, guaranteed loss of your money's buying power over time. For any long-term goal, avoiding that short-term volatility might actually be the riskiest thing you can possibly do.
So how in the world do you take all this theory and actually use it in your own life? Well, it all boils down to understanding your personal goals and, even more importantly, your timeline. Honestly, your time horizon is the most powerful weapon you have in your arsenal. If you're saving for retirement 30 years from now, you've got plenty of time to ride out the market's bumps and wiggles, so you can afford to take on more risk with things like stocks to really go for that growth. But if you need that money for a down payment on a house in 3 years, you absolutely cannot risk a big market drop. You have to put safety first.
Okay, so you've got the trade-off, you know your timeline. Let's quickly peek behind the curtain at a couple of powerful tools that professional investors use to manage this whole relationship a bit more effectively.
First up is diversification. I'm sure you've heard this a million times. Don't put all your eggs in one basket. It's a cliche for a reason. It works. By mixing different kinds of assets like stocks and bonds, you can help smooth out the ride because they often don't move in the same direction at the same time.
Second is a fancy-sounding metric called the Sharpe Ratio. Now, this sounds a little technical, but the idea is actually super simple. It just answers one question. For all the roller coaster volatility I had to put up with, was the reward I got actually worth it? A higher number is better. It means you got more bang for your risk buck.
So, at the end of the day, it all comes back to this one choice. Every investment decision you make is a balancing act. It's a negotiation between your ambition to grow your money and the prudence you need to protect what you already have.
And that leaves us with one last question to chew on. We are so often taught to fear the ups and downs of the market. But after everything we've talked about, what if the real risk isn't that short-term volatility? What if the real risk is playing it so safe that you guarantee you'll fall short of the goals that matter most to you?